So I thought I would show you what a futures quote looks like. There seems to be some confusion over how this contract is, what it means when we talk about a futures price and how the futures price moves and how a buyer and seller make money. What I have on the screen here is a CL. This is the contract for oil, and we can see that futures contracts trade in months, right? So you got to pick an expiration month. So we have November, December, January, February, March, April, May. This is for 2017. November and December for 16. Oil is peculiar. Even though this is the November contract, this is for delivery of oil in November. This contract will expire sometime October 17th. You've got to close your position. It just basically closes it for you. And then it's for delivery sometime in November, but no one really takes delivery. But you can see the actual prices here. If we were going to trade futures contracts, you can see for November delivery here we're at 43.84. But if you go all the way to May 2017, we're at 47.53. So it's not just one price. You got to pick a month, and then the month will have a price to it. This price trades like a stock all day long. It goes up and down. It ticks around. So what this means here is that 43.84. Let's say that I'm an oil producer and I want to sell oil and I want to deliver it sometime in November. I like the price of 43.84 because I think it might go lower. I'd like to lock in that price. I would sell, if I were going to deliver 1,000 barrels of oil, because CL's for 1,000, I would sell this contract 43.84, and in my portfolio it would show that I was short a 1 CL November 16 at 43.84. But this thing trades all day long, so there, as you see, it just went down to 43.82. So that's 2 cents down. This is 1,000 barrels of oil. Now it's 3 cents down. I'd be up $30. I would be up $30 because I locked in a price of 43.84. So my contract would be up. Well, now it would be up $40. Yeah, I should have done it, right? I'd be up $40 now. So let's say the price drops all the way down to $40. Since I got it at 43.84, I would make $3,840 I would make on the contract. But when I went to sell my oil in the spot market, I'd only be getting $40 for it. So I would lose $3,840 in the spot market, but I'd make that much on my futures contract. I lock in a price. But let's say that I'm just a speculator and I don't really care about delivering anything. I can trade this like a stock. I can short this, and I could say, well, CL, let me pretend CL is a company, and I'm just going to short it. So I would have shorted at 43.84. It would be the same as shorting 1,000 shares because one contract's 1,000 barrels of oil. Now I'm down to 43.80. I can close this off at any time by buying it. Think about a futures contract like buying a share of stock. Let's say you buy stock at $20 a share. If it goes up to $25 a share, are you making money? Yeah. At $25, does it change the fact that you bought the shares at $20? No. Once you buy at $20, you bought at $20 no matter where the price goes. It's the same with the futures contract. Once I sell a futures contract for 43.84, in my portfolio it says that I'm short one contract at 43.84. No matter where the price goes, my profit and loss is dictated by the price at which I entered the futures contract. But the futures contract trades all day long now. The next question is, well, what moves the price? Well, number one, the spot price will move the price. The closer we are to delivery, the more the price of the futures contract is influenced by movements in the spot price. However, the further out we go, the more the movement in the futures price may be influenced by macro variables, by supply and demand, etc. You can see we went from 43.80 to 47.53. Now this is part of this increase here is due to a no arbitrage pricing. For instance, if I could buy in the spot market today and store oil all the way to May, and it only cost me $46 to do it, and the contract's at 47.53, what would I do? I would immediately short the contract at 47.53, buy 1,000 barrels of oil in the spot market and put it into storage and deliver it in May and make easy profits. So the futures price still is a function of the spot price on the upside, but not so much on the downside, which means this could be selling for less than a no arbitrage price, and it might not correct. So the longer out in the future we go, while we're still influenced by the spot price, there are other factors that can move the futures price as well without the spot price really changing. But the closer we are to delivery, this November contract, this gets delivered in 1 month, October 17th. So this, as we get closer to expiration date, this will start to move closer and closer with the spot price, so that 2-3 days out from expiration, every penny move in the futures price is probably reflecting a move in the spot price. Now we're down to 43.77. So I'd be up $70 right now if I had shorted oil at 43.84. I'd be up $70. Look down here. Now you're probably wondering, well, where's the spot price of oil? Well, spot oil doesn't trade. There is no. You cannot trade spot oil. You must either buy it or sell it. So if you want oil at the spot price, you can go to Cushing, Oklahoma, pull up your truck and say, hey, give me some oil. And whatever the price is at that hub, that's what they'll sell it to you. This is for CL. This is for West Texas Intermediate. There are a bunch of different blends around the world. This CL here, this is for West Texas Intermediate oil, which is delivered at Cushing, Oklahoma. You can trade oil on the Brent contract, and that's for North Sea oil. There's West Canada Select, WCS, which is traded in Canada, I believe. I'm not sure which exchange it's on, but West Canada Select is a Canadian oil, heavy oil, which usually sells at a significant discount to West Texas Intermediate. So this is just one particular blend of oil that this contract tracks. Look down here. I got some more futures contracts up in a spot price. Now this is a currency. This is the US dollar, the US.CAD. How do we read this? This is saying that $1 US buys 1.3204 Canadian. $1 US will buy that much Canadian. And here are the futures contracts denoted in US dollars. So the Cad Futures Contract for September 20th, 0.7572. So if you take the inverse of the US CAD, you'll get the Cad futures price. Now, the futures price should move pretty much with the spot price, because we can trade, we can buy and sell spot, and we can buy and sell futures, which means we should have at all times a no arbitrage price on the futures and the spot. So for something like this, where you do have a tradable spot contract where you can buy and sell easily on the spot, the futures contracts will basically follow lockstep what the spot price would do. It would be almost inconceivable that a futures contract can get way out of line from a spot contract. And I say almost inconceivable because there are moments during the day where it can happen, especially right in front of a big report. You might be able to ding yourself into the spot at the low end. If you've got a bid out and the spread goes wide, you might get a really great price on the spot, and if you can instantaneously short the futures, you do pretty good. If you can, you need really fast systems for that. Plus, right in front of a big report, even though the spreads widen and you might get an opportunistic hit on your bid or your ask, there's almost no liquidity on those wide spreads, so you're probably not going to get it anyways. So I just thought maybe if you saw what it looked like on the screen, I mean, when I'm looking at this, if you're looking at this, if you didn't know that this was oil and I took away all the months and I just had CL and I had a price, would you know that that was a futures contract or a stock? So just think about buying and selling a futures contract the same way you would buy and sell a stock. If you bought a stock at $20 and it went up to 23, you still only paid 20. You just made $3 a share. It's the same with oil. You buy at 43.80, let's say, and it goes to 45. It's the same as buying a stock at 43.80 and having it go to 45. Same thing. Yeah, that's. I hope that sort of seeing it sometimes gives us a better idea of what it looks like. It's not so abstract. Now, before I go, these are futures. These are futures, not forwards. These are future contracts. These are traded on an exchange. This is spot currency, and spot currency trades 24 hours a day, all day long. In fact, these contracts here, they trade 24 hours a day as well on something called Globex. This is NYMEX oil, But at 2:30, when the market closes, CL continues to trade. It trades 24 hours a day. There's not a lot of liquidity at certain times, but it trades 24 hours a day. It shuts down, I think, for 15 minutes. Or is it? No, it shuts down between 5 o'clock and 6 o'clock it shuts down. At least on this system. And this is Interactive Brokers. There's no trading on it during that period of time. So it shuts down for 1 hour a day. Or is it 5 to 5:15? It's been so long since I traded oil, only because the trade is dead now. I mean, it's down, right? So that I've forgotten. But anyways, I thought you might like to see that. Yeah, my point. These are futures contracts, so they trade on exchange. If they were forward contracts, there is no second-to-second pricing. A forward contract is OTC, where you and I agree on a price and that's it. So from day to day, I don't know what the price is. So all we have to go on is the spot price. So a forward contract is if you and I enter into a forward contract, which is OTC, we'll enter into a contract, and let's say it's for oil, and let's say instead of $43.80, we agree on $44 for delivery in a month. I'll deliver and you'll accept. So we got $44 in a month. Well, it's a forward contract. It doesn't trade in the market. So from minute to minute to minute, there's no supply and demand forces on our forward contract pushing it up or down. It's $44. The only thing we have to go on is the spot price. That if we want out, we have to make reference to the spot price to see who's up and who's down. But in a futures market, you're on an exchange. It's like you're selling a stock. You're buying and selling a stock. It's the same process, the same mechanism. It's just the underlying is a futures contract based on, 1,000 barrels of oil. There we go.